Welcome to The Explainer. Today, we're tackling one of the most fundamental questions in all of business and investing.
I mean, that's the multi-trillion-dollar question, isn't it? It's one of the biggest questions in finance. And today, we're going on a journey to explore everything from the classic models to the very future of how we determine a company's true value. So, here's our game plan for today. We're going to start with the basics. What makes a company valuable in the first place? Then we'll see how the early models evolved into much more complex approaches. After that, we'll get our hands dirty with the workhorse of Wall Street, the DCF model, and its cousin, market comps. And finally, we'll take a peek into the future of valuation. All right, let's start at the very beginning. We're going to go back to the first truly revolutionary attempt to put a number on an asset's value by focusing on one single core idea: its risk. Back in the 1960s, this thing called the capital asset pricing model, or CAPM for short, was an absolute game changer. It introduced this simple but incredibly powerful idea. The return you should demand from an investment depends entirely on how risky it is compared to the overall market. They even gave that riskiness a name: beta. But, theories are great until you test them against the messy real world. As researchers got their hands on more and more data, a big problem started to emerge. That one factor, that single puzzle piece called beta, well, it just wasn't enough. It couldn't fully explain why some stocks consistently did better than others. The puzzle of value was clearly missing a few pieces. And that gap, that realization that something was missing, it led to a major evolution in financial thinking. We had to move away from that simple, single-factor view of the world to a much more complex, multi-factor one. And this visualizes that shift perfectly. While CAPM tried to balance everything on market risk alone, these new multi-factor models were way more sophisticated. The most famous one, from Fama and French in the early 90s, identified two other key factors. They found that company size mattered. Smaller companies tended to outperform bigger ones, and so did value, meaning companies that looked cheap on paper also tended to outperform over time. Okay, enough theory for a minute. Let's move from theory to practice and talk about the tool that analysts use every single day to figure out what a company is fundamentally worth, what we call its intrinsic value. We're talking about the discounted cash flow model, or DCF. And honestly, the core idea here is pretty intuitive. What's a company worth? Well, it's worth all the cash it's going to generate for the rest of its life. A DCF is just a way to add up all that future cash, but in today's dollars, because of course a dollar tomorrow is worth less than a dollar today. So let's walk through it. It all starts with forecasting a company's cash flows for the next 5 or 10 years. Then comes a really critical step. You have to estimate the company's value for every year after that, which we call the terminal value. Next, you discount all those future dollars back to what they're worth today. And finally, after a few tweaks for things like debt, you can get to an implied price per share. It's a lot of steps, but it's an incredibly powerful process. Now, that terminal value we just mentioned, it is hugely important. In fact, it often makes up more than 3/4 of a company's entire calculated value. This means your assumptions about the long-term future are pretty much everything. Analysts usually use one of two ways to figure it out: the perpetuity growth method, which assumes the company grows slowly and steadily forever, or the exit multiple method, which pretends the company gets sold at a price based on what similar companies are worth. So here's a crucial point, and a super common mistake. Valuation is always forward-looking. It's about what a company will do, not what it's already done. But you'd be amazed how often a simple spreadsheet error leads to someone including past cash flows in their forecast. This is a massive flaw, and in some cases, this error alone can puff up a valuation by 15 or 20%. But see, a DCF calculates a company's value kind of in a vacuum. To get the whole picture, analysts need a sanity check. They need to step back and see what the market thinks a company and its competitors are worth right now. And this is where comparable company analysis, or just comps, comes into play. The logic is really simple. Similar companies ought to trade at similar prices relative to their performance. So analysts will look at a group of peer companies, check out their valuation multiples, like their total value compared to their earnings, and then apply that average multiple to the company they're analyzing. It gives you a great snapshot of what the market thinks. This table lays out the different approaches really nicely. A DCF is all about finding an absolute intrinsic value based on a company's own future. Comps, on the other hand, give you a relative value based on what the market is paying today. And then you have a third method, the leveraged buyout or LBO model. This one figures out a valuation from the viewpoint of a buyer using tons of debt, which usually sets a kind of floor price for the company. I absolutely love this quote from NYU professor Aswath Damodaran, who is basically the godfather of modern valuation. It's such a critical reminder that even with all these powerful models, valuation is still part art, part science. The spreadsheets are just tools. They depend completely on sound human judgment and good assumptions. There are no magic boxes. So, for our final section, let's look ahead. Let's see how technology is pushing the boundaries of valuation and how it might be shifting that delicate balance between art and science. Here's the big challenge. Traditional models are pretty good, but they kind of assume the market moves in straight, predictable lines. And we all know it's way more complex and chaotic than that. This is where AI and machine learning are starting to come in. These models are designed to find those hidden, complex patterns in huge amounts of data that traditional methods would just completely miss. And the results are pretty compelling. There's a metric called the Sharpe ratio, which basically measures how much return you get for the risk you take, and higher is better. Studies have shown that most traditional investment strategies have Sharpe ratios below 0.5. But in contrast, some back-tested machine learning strategies have hit Sharpe ratios around 2.0. That's not just a small improvement. That's literally a quadrupling of risk-adjusted performance. AI is transforming this field by using totally new data sources. We're talking about analyzing satellite images of parking lots or scraping social media for sentiment to boost accuracy. But it's not a silver bullet. These models have their own challenges, like the risk of being overtuned to pass data, and of course, the famous black box problem, where it can be really hard to understand how the model actually made its decision. And this leaves us with a final big question to think about. As these powerful new technologies keep getting better and better, what role is left for human intuition, for judgment, for the art of valuation in this timeless quest for true value?